Hey, you ready to get a grip on the nuts and bolts of the economy and maybe some of those like cornerstone finance ideas?
Absolutely. Things you hear about all the time.
Yeah, and we're not just talking exam stuff here. This is really about understanding, why markets move, maybe making sense of crypto buzz.
Exactly. It's about real-world application. And honestly, these basic economic ideas, they're kind of the blueprint for so much in finance.
Okay, good. So let's start right at the beginning then. Economics. What is it really?
Well, at its simplest, it's the science of choice, isn't it? How we allocate limited stuff.
Stuff like time, money.
Energy, right? All limited. But our wants, they seem pretty unlimited.
Huh, tell me about it. So
Right.
that's the core problem. We always want more than we have.
That's scarcity. Yeah, that fundamental imbalance. It forces us to make decisions.
And every decision means not doing something else.
Precisely. And that something else you give up has a value. That's what economists call opportunity cost.
Opportunity cost, right? So it's the value of the thing you didn't choose.
Exactly. Let's say you have, I don't know, $100.
Hmm.
You're thinking maybe buy some Apple stock or perhaps some Bitcoin.
Okay, two options.
If you go with Apple, the potential gain you might have made from Bitcoin, that's your opportunity cost for choosing Apple.
Ah, got it. And this isn't just theory, right? This pops up in finance.
Oh, constantly. Especially in things like net present value analysis in the CFA curriculum. You're always comparing the return of one investment against the potential return of the next best alternative.
Yeah.
It's about choosing the best path for your limited capital.
Makes sense. You got to know what you're giving up. Okay, so from individual choices, let's zoom out the big picture, the economy as a whole. GDP comes up a lot here.
It really does. Gross domestic product. It's like the main number everyone looks at to gauge a country's economic health.
And it measures what exactly?
It's the total market value of all the final goods and services produced within a country over a specific period, usually a year.
Okay, final goods.
Yeah.
So not the components, but the finished product.
Right. Avoids double counting. Now, there's a key distinction you often hear. Nominal versus real GDP.
Yeah, I've heard those terms. What's the difference?
So nominal GDP uses current market prices. The problem is, if prices go up, inflation, nominal GDP goes up too, even if we didn't actually produce more stuff.
Ah, so it can be misleading if you're looking for actual growth.
Exactly. Real GDP adjusts for that inflation. It uses constant prices from a base year.
Yeah.
So real GDP gives you a much truer picture of whether the actual volume of output is increasing or decreasing. That's the one we usually focus on for growth.
Okay, real GDP for the real story. So how does this link back to investing? Say, I'm looking at a company's stock.
Great question. Let's take a hypothetical company,
Hmm.
Company X. Imagine they export a lot of their products to, say, Germany.
Okay, big German market for them.
Now, if you see that Germany's real GDP growth is strong, what does that suggest?
That the German economy is doing well. People and businesses there have more money to spend.
Precisely. So demand for Company X's products in Germany is likely to increase.
Which could mean higher sales for Company X.
Better profitability?
And maybe a higher stock price.
Potentially, yes. It creates a more favorable environment. The CFA program really emphasizes making these connections, linking broad economic data like GDP to the potential impact on specific assets.
Right, it's connecting the macro dots to the micro impact. Okay, that's helpful. Now let's shift gears again. Back down to the company level. Financial ratios, another big area in CFA, right?
Huge, absolutely fundamental. Ratios are like financial health checkups for a company. They take raw numbers from the financial statements.
Balance sheet, income statement.
Yeah, those. And they turn them into comparable metrics that tell you about profitability, liquidity, leverage, efficiency.
Can you give us a couple of key examples?
Sure. A common one is the current ratio. That's current assets divided by current liabilities. It basically asks, does the company have enough short-term assets to cover its short-term debts?
Okay, so ability to pay bills soon.
Pretty much. Then there's return on equity, or ROE. Net income divided by shareholders' equity. This one tells you how well the company is generating profit from the money shareholders have invested.
Right. How much bang for the buck the shareholders are getting?
You got it. And another important one is maybe the debt-to-asset ratio. Total debt divided by total assets shows how much of the company is financed by debt.
Okay, so we have these ratios, but you don't just look at one in isolation, do you?
No, definitely not. That's the key. You need to analyze them together holistically. For example, a company might have a current ratio below 1, which sounds a bit scary, right? Suggests potential trouble paying short-term bills.
Yeah, that wouldn't look great on its own.
But what if that same company has a really high ROE? It might mean they're just managing their working capital very tightly, very efficiently to maximize profits. So the low current ratio isn't necessarily a red flag when seen in context with strong profitability.
So it's about the whole picture, the story the ratios tell together.
Exactly. The CFA approach stresses looking at the relationships between different ratios to get a nuanced understanding.
Okay, that makes sense. So we've got the big economic picture, the company's specifics with ratios. What about the human element? Markets aren't always perfectly logical, are they?
Far from it. And that brings us to another fascinating area, behavioral finance. It acknowledges that we humans, well, we're not always rational economic machines. Our psychology plays a huge role.
You mean things like getting caught up in the hype?
Precisely. Think about FOMO, the fear of missing out. People see an asset price soaring, maybe a stock or crypto, and they jump in purely because they don't want to miss the gains, often buying near the peak.
Yeah, I can see that happening. Any others?
Oh, plenty. There's anchoring, getting fixated on a specific price point, like the price you bought at, and letting that irrationally influence your decision to sell or hold, even if fundamentals change.
Sticking to a number even when it doesn't make sense anymore.
Right? And hurting. Just buying something because everyone else seems to be buying it without doing your own homework. Safety in numbers or perceived safety, anyway.
It sounds like psychology driving decisions more than analysis.
Often, yes. Look at the crypto market sometimes. You might see a big holder, a so-called whale, sell a large amount of Bitcoin. That can trigger fear, right? Smaller traders see the price drop and panic sell too, not based on any new analysis, just fear. It creates a cascade.
Driven by emotion, not logic.
Exactly. And being aware of these biases both in the market and crucially in ourselves is a big part of what the CFA program tries to instill. Recognizing them is the first step to not letting them dictate your investment strategy.
That's a really important point. Awareness is key. Okay, one last crucial area, especially tied to the CFA designation, ethics.
Absolutely paramount. You can be the smartest analyst in the world, but if you breach ethical principles, your credibility is gone instantly.
So what are some core ethical ideas here?
Well, things like transparency, being open and honest, not hiding important information from clients or the market. Avoiding conflicts of interest is huge. Disclosing situations where your personal interests might clash with your professional duties.
Like recommending a stock just because your firm is underwriting it.
That's a classic example. And integrity, acting honestly, professionally, not, putting out overly optimistic analysis just because it might benefit you personally.
It sounds like it's about building trust.
That's exactly it. At the end of the day, the CFA charter isn't just about certifying analytical skill. It's about fostering individuals who are trustworthy stewards for their clients, for the market, and for the whole financial community. Trust is the currency of finance, really.
That's a powerful way to put it. Okay, so we've covered quite a bit the basics of economics like scarcity and opportunity cost.
How we measure the big picture with GDP, especially real GDP.
Diving into company health with financial ratios, looking at them together.
Understanding those behavioral biases that affect us all, like FOMO and hurting.
And wrapping up with the absolute importance of ethics and trust.
Yeah, quite a journey through the foundations.
So as you, our listener, go about your day, maybe reading financial news or thinking about your own investments, try to see how these threads connect. How does a change in GDP potentially link to a company's prospects? Are you seeing any behavioral biases play out?
It's about connecting these concepts to the real world around you. And maybe final thought to leave you with.
Go for it.
How does really grasping these core principles, economics, ratios, behavior, ethics, how does that empower you to navigate the, let's face it, often complex world of investment with maybe a bit more clarity and confidence? Something to think about.